welcome to this 15-minute Q&A panel titled Which Listed Fund for Your Portfolio? It's part of the Pinnacle 2022 Investment Summit. My name is Chris Mayer. I'm the Director of Listed Funds at Pinnacle, and I will be the panel host today. Listed funds, of course, are ETFs and LICs, and that's what we're going to focus on in this session. Australia is one of the leading markets globally, actually, in listed funds. It's an industry that now has about $175 billion of assets in it across ETFs and LICs. ETFs leading the way with $125 billion of that. Listed funds increasingly are becoming an investment vehicle of choice for investors in Australia, particularly stockbrokers and direct investors who like the convenience, the simplicity, the transparency, the liquidity that comes with listed funds. Pinnacle itself is now a substantial player in the listed fund market. We have about 9 listed funds across many different asset classes, totaling about $8.5 billion of assets. So we're very committed to this industry. You can find our listed fund selection if you click on the link, listed fund flyer in the key links section of this dashboard. I'm very excited today to introduce our panel of experts. Firstly, joining us from Sydney is Andrew Tang, although you wouldn't see that he's from Sydney. He's in the blue blazer there. Andrew Tang is equity and fund strategist at Morgans Financial. He spends a lot of his time selecting shares and funds for the Morgans network, so is an expert on fund selection. Daryl Wilson is our other panelist today. Daryl joins us from Brisbane. Daryl is CEO and founder of Affluence Fund Management, a specialist fund manager who runs many fund of funds, specializing in selecting some of Australia's leading fund managers, and actually has a fund that specializes in LICs. So both our panelists today are experts, fund selectors and listed fund experts, so we're very lucky to have them with us. Andrew and Daryl are here to talk to us about 7 of the listed funds that Pinnacle has that we're going to present to you today. They're going to talk about 3 things on each of those funds. They've got a strict time limit, 1.5 minutes each per fund. And those 3 things are: what do they like most about the fund? What do they like least about the fund? And how do they feel the fund can fit into a client's portfolio? So let's jump into it. First up is Hyperion. They are a global equity ETF with ticker HYGG. HYGG is a high conviction portfolio of 20 to 25 global equity shares. It's been around since 2014, but is quite a recent entrant into the listed fund world, having listed on the ASX in March of 2021. The fund now has about $2 billion of assets in it. Andrew, over to you. What do you think of HYGG?
Thank you, Chris. HYGG, well, it is part of the Morgans model portfolio. What we like about it, the team has had a lot of success, an enviable track record managing direct equities, particularly in the domestic side, over 20 years. They have, as you mentioned, run the strategy, translated that strategy in 2014 to global equities. It is one of the few true to label growth fund managers in our stable that we look at. And, you know, one of the few managers that really take that 10-year view, long-term view on a company. They look at the earnings, the valuation, and they've got a really strong track record of selecting companies that have the potential to grow into a large addressable market. So they have done that very successfully over 8 years now, and they've also done that for domestic equity. So the last point that often gets missed with HYGG is it's really strong retail marketing material. They've got company snapshots, really interesting insights about companies as well as how they're seeing the world, which really helps a client understand what they're investing in. So we really like that. What we like least about the fund is obviously with a growth style bias, you are likely to see some short-term bouts of volatility and underperformance during periods where you do see a cyclical or value tilt in the market, which we've seen over the last few months, it's also got a lot of high beta names. So periods of market stress, you are likely to see some drawdown on the portfolio. The other thing is the workload manager. Obviously, with the fund managers looking at not just global equities, but the domestic equities, but the team have shown to be able to manage that workload quite well. And in terms of how it fits in the portfolio for us, it is a core holding in the accumulation portfolio. Whilst in the last 8 to 9 months, it's been quite tough for a growth manager. But many of the structural themes that HYGG and the team at Hyperion look for are not going away anytime soon. So we like the rigor in which they approach portfolio management, and its effective way, we believe an effective way to get access to those themes.
Great, thanks, Andrew. Next up is Antipodes. We're staying with global equities, but we're switching to value from growth. So AGX1 is the ticker. It's the Antipodes Global Shares Fund. It's been around since 2018, but most recently it exchanged from an LIC with ticker APL into the ETF AGX1. It's got about $350 million of assets in it. Andrew, what do you make of AGX1?
Yeah, thanks, Chris. Like Hyperion, it is one of the few true to label value fund managers out there that we look at. We like that structure change from the LIC to the ETF. So we really commend the team at Antipodes as well as Pinnacle for making that transition. We like the approach that they take towards how they're looking at the companies under their universe, which they invest in. So both a combination of quant as well as that fundamental approach to the portfolio. So not just value for value's sake. They're really studying some of the cyclical, some of the structural, as well as the macro forces, really driving those companies behind that portfolio. We also like the fact that they keep capital preservation front of mind when they're investing. Capital preservation has been quite strong and a focus of the fund. And unlike their unlisted fund, the listed ETF has only a long-only exposure. So from an asset allocation point of view, that makes a lot of sense and it suits our clients a lot better. I guess some of the things we like least about the fund would be undoubtedly there is some key person risk. Jacob Mitchell, who is really the heart and soul and the driving force behind the firm. However, we do note that there are 5 portfolio managers which support Jacob as well. There's also a fair bit of concentration in the portfolio, having a large geographic exposure to Asia. As I understand, about 22% exposure to Asia as of the last update at the 31st of July, 13% weight to China and 4.5% to Taiwan. So that's something to be mindful of, given it's a little bit skewed compared to what you see in a normal global equities portfolio. The ETF also uses currency hedging, exchange trade derivatives as downside protection, so something to be aware of there. And then how it fits, look, we see this as a satellite, a tactical exposure to value. The benefit also, just given that Asian exposure, which I highlighted as one of the risks, could also be looked at as a benefit, getting that EM exposure as well by a manager that has a lot of experience investing in the region. So certainly see it as a good fit for a tactical, a satellite play in a portfolio.
Great. Okay, Daryl, let's bring you in here. We're going to switch to Aussie equities now, and we're also going to change from ETFs to. So first up is Plato Income Maximizer, ticker PL8. It's a bit of a market darling in the income space, designed for retirees. It's a portfolio of Australian equities. It's got about $600 million in it. Daryl, where do you see PL8 fitting in your clients' portfolios?
Yeah, thanks for inviting me along, Chris. Appreciate it. So look, Plato's in that equity income space, obviously, and by and large, it's actually a bit of a graveyard for managed funds in general. So Plato is really a standout within the equity income space. They do it exceptionally well. They've outperformed the index over a long period. They've got quite a distinct style that allows them to take maximum advantage of the franking credits, which is also important for an Australian investor. And obviously, you've got the monthly income as well, and the fact that PL8's fairly large and liquid, as you say, so easily tradable as well. Probably the one negative I'd point to at the moment as a temporary factor is it is a market darling, and that means it's traded up to a reasonable premium to its net asset value. So I think that's currently in the order of 10 or 15%. But potentially you could look at the managed fund perhaps if managed fund equivalent if that's an issue for you right now. In terms of portfolio uses, obviously you've got, it falls within the equity bucket, but you're going to get equity-like returns with a bigger slice of income. So if for retirees, as you said, that have got a bit of an income bias in their portfolios, I think it's a pretty good one to take a look at. And that's really where it belongs. You've got to understand that there's going to be a little bit of up and down with the market as well. So it's not a pure income product, but to give you that income plus type exposure, PL8 very much is a standout.
Great, thanks, Daryl. And maybe moving down the market cap spectrum a little bit into small caps. Another lick, also Aussie equities, is Spheria Emerging Companies. Its ticker SEC. Actually coming up for a 5-year anniversary now in November, so it's been around a bit. Small cap licks themselves haven't traded particularly well relative to their NTA, but Spheria is one of the better ones. It tries to beat the small cap index and tries to produce some income off the portfolio as well for investors. Where would you see it fitting in, Daryl?
Yeah, look, it's an interesting one actually. It's right up our alley because I think it's got a value focus, as you said, a strong value bias, and we feel right now that's the place to be in the market generally. Growth's had a long run, value not so much, and the Spheria team has managed to outperform the market even with that kind of value headwind, if you like, for the last few years. So we think that's turning, and now that's a really good time to look at Spheria and other value managers. The team's been together a long time. They've got a very, very good track record, as I said. We like that, the team continuity. We like the fact that it's a good blend of a reasonably concentrated but not too concentrated portfolio. So you are getting a real opportunity there to add value. A lot of the factors that we look for in a manager which allows them to add value are present with SEC. I guess the one negative I'd point to, which is really an issue with all small cap managers, is they can be quite volatile. And you would have seen earlier this year, the markets traded down. Obviously, the ASX corrected about 10%, but small caps were more like 20 to 25% corrections. So you're going to get bigger volatility, but potentially a better overall return if you're there as a long-term investor and you can handle that. We very much like it as part of the small cap portfolio. The fact that it pays a quarterly dividend is also a benefit. So you're getting that combination of the small cap exposure, but perhaps 4 or 5% returns from income a year as well, which is, again, quite unusual in that small cap space. So that makes it definitely differentiated and one of the first ones we'd look at.
Great, okay, that covers, thanks, Daryl. That covers the pure equity bucket. We now switch to the real estate allocation. It's not an allocation that everyone focuses on. It's slightly more niche, but we've got a new entrant into that space in the listed fund format with Resolution Capital Global Property Securities Fund. Its ticker RCAP. The fund itself is old. It's been around since the GFC in 2008. But the listed fund, it's been around since February of this year, listed on the ASX then. Fund's got about $2 billion in it. It's one of our better rated managers across the board. Andrew, maybe back to you. What do you think of RCAP and what are you doing with G-REITs in your client portfolios?
Yeah, thanks, Chris. Look, like you mentioned, it's not an asset class that that a lot of clients typically look at, just given maybe the huge portfolio weighting to Aussie property already. But here, I guess what you're looking at is a global diversified set of stocks between 40 to 60 across sectors and different geographies. The team maintains a very low turnover, so you're not getting a huge sort of turnover. They have sort of long-term views and thematics with a strong focus on quality. So the fund is part of our global G-REIT portfolio. as part of the Morgans model portfolio. So we like it. It's a strong management team that's been together for a very long time. Andrew Parsons being the founder and CIO. We also like its decentralized management structure, the team of 4 making decisions there. So in terms of that key man risk, you don't really have that, just given the strength of the team and the bench strength there. And then top of the class performance. So over a long period, it has continued to outperform peers, and if not the top quartile, pretty close to. So a really enviable track record there. I guess maybe a couple of points really why maybe you could sort of look at it and not like it so much. Well, compared to A-REITs, the dividend yield is a little bit lower than what you're typically used to if you are a purely A-REIT investor. So you may look to supplement the income that you're perhaps not getting out of this fund if you are used to A-REITs. And then really nitpicking here, but the fund was a little bit slow out of the blocks when it came to coming out of COVID. So they have since bounced back in terms of the performance, and they are trading closer to benchmark as well as peers. In terms of a fit, there's no surprise then, just given its position in our model portfolios under that G-REIT asset class. It fits in both our income and our accumulation model portfolio.
Okay, the final 2, and we're on the home stretch here, on the fixed income bucket. So Daryl, first to you on metrics. MXT is really sort of a flagship credit LIT on the ASX. It's got 1.7 billion odd of assets. It's been around 5 years. It's in a lot of investors' portfolios. What do you make of it?
Yeah, look, it's I think certainly the things we like about it is it's a fairly bulletproof loan portfolio, hugely diversified. There's around, I think, 275 loans in there at the moment, and that's important when you're looking at a debt vehicle. It's absolute bank quality, and in a lot of cases, I know the team is participating in the same loans that the large banks would participate in. So credit quality is exceptional. And the management team is exceptional as well. Again, they've been together for quite a while, and I know there's various products the team manage, but this is really at the more conservative end of the market. It's large and liquid, as you said, so trading it is no problem. It's largely floating, so that's important at the moment with interest rates trending upwards. That I guess the returns on the underlying loans can keep pace with those increasing interest rates. The one negative being an LIT is that it does move around a little bit in periods of market turmoil. So, if you're looking at a pure income bucket, an income product, you will see this perhaps come back a little bit. Not the NTA. The NTA is rock solid, but it will trade below its NTA during periods of market distress. Some see that as a negative. We see that as an opportunity. It's one of 2 go-to debt funds when we see real market dislocation that we would buy and get a little bit extra out of that NTA recovery profile. So it really fits, I guess, squarely into the income bucket with the opportunity to perhaps top up a little bit when you see market disruption and add a little bit of extra alpha that way.
Okay, thanks, Andrew. You get the final word here, and the final listed fund is Coolabah's composite bond fund. Its ticker is FIXD. It's really I guess a straight down the fairway bond fund. It's got a bit of duration, bit of credit. It tries to outperform the Ausbond Composite Index by 1 to 2% per annum. It's got $175 million of assets in it, and obviously Christopher Joy is no stranger to many of the viewers with his fin review profile. So what do you make of the fund, Andrew?
Yeah, thanks, Chris. Yeah, lucky last. The fund, as you mentioned, backed by a very strong, really institutional grade fixed interest team, really with that background around quant as well as qualitative factors. We think where this fund really comes to really shines is the fact that it gives investors fixed income exposure, so your traditional yield and defensiveness, but enhanced with the smarts, their unique style of active management. So we like that, given you're getting that active overlay on some very vanilla, as you say, straight down the fairway type of products. So what we dislike about this fund, or some of the things that are probably you just have to be mindful of, is the fact that there is some duration exposure. So in line with the index, when you do see rising interest rates, that does have an impact on the fund. There is duration in there, and particularly also when credit spreads widen. So you do have to be mindful of that. Where this fund really does excel is where there is mispricing and there is a little bit of volatility in fixed income markets. It's not going to perform when markets are a little bit more benign. So how we see this fund fitting in a portfolio is really as a tactical option. Those in your fixed income bucket where you're looking for an enhanced return, holding some of the more vanilla bonds, we think this is a great option there.
Okay, great. Well, that's 7 funds in a little over 15 minutes. We hope it's given viewers a sense of where those funds might be relevant to their own clients' portfolios. Andrew and Daryl, thank you so much for your time and your insights. You really are experts in this field, so we appreciate you offering your views, and we wish you luck in your own businesses for the rest of the year. And thank you again to the audience for tuning in.